Hello viewers, welcome to our video series. This is going to be part 2 of the Fibonacci retracement that we explained last week. If you have not watched that video, please stop now, go back and watch the video because this is a continuation of that video. I will drop the link to that video in the comment section. And then this week, what we're going to focus on is how to use the Fibonacci retracement we learned last week to make key decisions in taking trades. Secondly, we will towards the end of the video, what we'll do is to actually go back into the chart as usual and then do a practical example and do a look ahead with our tools. What is the closing week of 2023 likely to look like, and what opportunities we have in the days to come. Please sit back, relax. This is going to be a very loaded series with full information that you can take to the market to trade. I'll be back after the short break. Thank you. Welcome back. As I said earlier, this is going to be a continuation of our part 1 on Fibonacci retracement. If you have not subscribed to our channel, kindly hit the subscribe button now, like the video, and also you could share to your friends if you find the content valuable. So, jumping straight ahead on what we're going to cover today, I will do a little recap on the Fibonacci retracement we learned last week. Then I would also go to, though we have another video on candlesticks, a full video on candlestick and candlestick pattern, but I will pick some content from candlesticks, give a brief explanation of the Japanese candlestick, and trader psychology and the candlestick pattern itself. How to combine these tools as a using these tools as a confluence with your Fibonacci retracement learning here to make better entries and take good trades. So sit back, relax, and let's move forward. Now, on candlesticks, you could see that I have a live chart in front of me. What I will do is to explain different type of candlesticks here on the live chart itself, the canvas. So, for example, you could see if you look closely, what comes to you first is the different colors. We have the red, you have the green. They symbolize different things. I will come to that. But again, let's go to shapes, because a candlestick actually is about the shapes itself. It's a rectangular body. Let me zoom this out better. Okay, so you have rectangular body. If you look closely, you also have some lines running into the rectangular bodies. The rectangular body is called the body as usual, and the lines running into them from below and above, they are called the wicks. These wicks also have different interpretation depending on that. So I will take different type here, explain them, what they look like, what they are, and then what are the what do they communicate to us. Okay, now if you look at this big bold one, you almost would not see the wick here. Very little wick. Some would actually come without a wick. If it comes without a wick, it's called marubuzo. The marubuzo candle, I think that will be the third one I'll explain. Let me explain the normal candle first. The normal candle are those that has 2 wicks. Let me use this as an example. You have a body, then you have a wick. The body is an indication of the trade volume that happened within that time frame. In this case, I am on the weekly time frame. So within 1 week, there is this volume of trade, that's momentum, trade momentum that happened in this time range. So it shows here that prices of this asset actually went as low as 1334 here and as high as 1410. What is this the beginning of the body here is actually the opening price here, 1340. It either, I don't know whether it went up first or down first. It opened at 1340, went as low as 1334, moved forward and went as high as 1411, but eventually closes at 1399. Now, this is candlestick. So what this indicates is that, and the colors you see here, or the movement, the gap, whatever it is actually me and you that takes trade at various time of that within that time frame. So what it means here is that while this market opens at 1341, traders came in and sell. They begin to sell this asset until it got to 1334. Then buyers took over and they begin to push high, push high, push high. They push all through to 1412. Then there was a thought, there was a psychology around, oh, this is actually overbought at this moment. Then sellers begin to set in again, begin to sell the asset, and eventually closes at 1398. I hope this is clear. This is basically all that happens within a candlestick. Now, going forward, what does this, as I said, when it went low this way, the only reason you had a wick here was that from the opening price of this candle, when from the opening price, the sellers came in, they push it down, and then buyers took over and they push it up. Then it they set in again and it closes here. So what it means is that when you see a wick in a candlestick, it actually denotes the pressure, the market pressure around that period. As I said, it's going to be a brief introduction on this and then move on to our main topic. I won't take much time here, but the different type of candlestick I want to identify for us, because we're going to use them in the future, is this type of candlestick where you have a long wick at one end of the body and at the other side almost nothing. This is called hammer. If it's upside down like this, it's called inverted hammer. Then the other way around, you know what it is. So this is another example of this in the uptrend. This downtrend indicates that there was, the market went as high as 1437, but sellers selling pressure mounted on this, and then the trade volume actually closed lower. So this is an indication usually that there is a selling pressure. When the reverse is the case, where you have this, is an indication that you have a high a buying pressure. At this level, you actually have an equilibrium. There is very huge volume of trade. There is an equilibrium in this. Both buyers and sellers, they have the equal momentum, but unfortunately, because this end up red, meaning this market here, if I read these two candles together, there was a buying pressure here. With that buying pressure, they entered the market here. The market closed here and the market started here, but sellers jumped in immediately and pushed this down all the way to this point, which means sellers has more upper hands here. If you look this, what it will change your psychology towards thinking maybe the market is turning to a selling market. Then you have doji. Doji is where you have indecision. The more like an indecision, but it usually also denotes a turning point where you you don't have a body at all. Similarly here, this is short. With this, what this tells us, the range here is very close, which means there is less volume. usually you don't take markets when you have this type of decision, but what you look out for is that, okay, potentially there is going to be a break soon, because when there is no, these people are watching, there are different things, looking at the market psychology, looking at fundamental news and stuff like that, events happening around the world, to make the next decision. Then it is and when this happen around area of interest, we'll come back to this. This is where our reference to the Fibonacci retracement we did is going to come in handy. When this is happening around areas of interest, you wait and observe, and then look at the next information that the candles will be providing. Okay, that is that on a quick introduction on candlestick pattern. There is, let me look for this. We have, there is a particular candlestick pattern that I would like to use if I see it, but otherwise okay, let me move to the next one. Trading psychology, as I said, usually it comes from here. What this is technical, this is pure technical analysis. What you are seeing here is an interpretation of what happened in reality. Okay, so the psychology of the traders, most of them would take into whatever factor they have put together to make their trading decision. It's usually indicated here. So the psychology here, when you see this type of candle, thick candle, is that sellers are in control. So what usually would happen is that you would expect with this huge long candlestick where you have sellers in control, dragging the market opened here and they pull it all down here. Your expectation will be that, come on, next week sellers might still be in control, which actually happened here. Okay, so this the little I'll take on market psychology. Then the candlestick patterns themselves is what is this? What pattern, what formation is the candlestick giving us? There are various chart patterns that I have discussed candlestick standalone now, but when a collection of candlesticks come together to form a shape, what does it tell us? In this, I'm zooming out so that I can have a clear I have clear vision now, visibility now. If you look at this candlestick pattern forming here, you could see that when sellers push the market here, when sellers push the market down here, it did not only stop here, it began to range and continue to go down. In this case, you will say that the market is trending, is going downward. You begin to have series of lower low, lower high, lower low, lower high, lower low, lower high, lower low, lower high, and so on. So when this begin to happen, then the market is in the downtrend. Okay, similarly, if it's the reverse, if the reverse is the case, you have higher low, higher high, higher low, higher high, higher low, higher high. In this direction is trending upward. So this is the first one. You have an upward, you have a downward trend. They denote different things. Then at the end, area of interest now, at the end of the candlestick pattern, at the end of the run, either the uptrend or lower trend, there are usually some patterns that plays out in the form of drawing. You have the rectangular pattern, you have the wedge pattern, you have the triangular pattern. You have the triangular pattern, usually we call it flag patterns. Okay, I need to make drawing of this. Okay, let me use this tool to quickly show you what I'm talking about. Come here. Sorry, let me change it to line. Okay, bold. Yeah. Let me change the color to black. Okay, so what I'm saying is for rectangular pattern, flag pattern, you could have something like this. Change this to no fill, change the line to black, then thickness to 2. Okay, so don't mind my drawing, it's just for explanation. So this is a flag, right? Because you have the stick, you have the flag. This is this is in an upward trend. If it's in the downward trend, you could have something like this where you have the market trending down, and then you have a flag down here. Okay, I will explain the different formation. You're not going to have it in a perfect shape like this. It could slant down, it could slant let me see, can I use this? Yes, I could use this for that. Okay, good. That's the best one to use, so that I can explain the concept correctly. So in this case, for example, you have this slanting downward. Though it's a flag, because it's rectangular in shape, you have market moving. What it means is that the market might be moving in this direction, any different zigzagging direction, but yet is moving within this is moving within the rectangular shape, but in a downward trend. In this case, this is a flag pattern that is sloping downward. It denotes a continuation pattern. What this usually do, if you see it in a downward trend, is that the next move is going to be downward. If the reverse is the case, is if it's upward. And then you have some shapes that comes out like this. Let me take this. This is the wedge pattern. This is the wedge. So this wedge pattern could be, it happens in an uptrend. It also happens in a downtrend towards the end of a turn. Okay, in this case, if you check very well here, you are seeing this formation where you, as I said, this is in the real life, you will not have a perfect shape. But if you think that this shape here, this wedge is almost fitting into this, let me do it here. Okay, then while this denotes this movement up in an uptrend, then it has its meaning. Okay, this is the type of shapes you look out for. What happened eventually, this breaks up before the down movement. Similarly here, if it's on the downward trend and you find a wedge, definitely if it's inverted, let me invert this. If it's inverted like this and it's in a downward trend, what you would expect is that once this consolidation, this is called consolidation, once this consolidation complete, what you expect first is that it's going to break down before the reversal. What these shapes indicates is that they are reversal pattern. They are called reversal pattern. So if you found them at an area of interest, especially at the supply and demand zone, then you get ready that the market is about to turn. Now, I will continue after the short break. Please, if you have not subscribed to this channel, hit the like button and subscribe to this channel. See you after the break. Welcome back. Before we proceed, let me now make a quick recap of what we learned last week on Fibonacci retracement. Fibonacci retracement is usually used to determine where the retracement level of a trending market would go when it returns. I would use this is the weekly time frame, for example. Okay, now from here, if I look at this, let's say I looked at this, for example, I'll place the Fibonacci retracement tool here. This is an uptrend, right? I start from this lower wick, move it to this higher wick, Then stop here. So what happened is after I draw this, what will happen is I will look that, okay, from here to this position, what will happen if this retraces back? So what we're saying is that it will retrace back to one of these retracement levels, okay, and which is actually region or zone, as we explained last week. From here, it came back to the 0.23, which is here. It break through, it didn't stop. It went straight to the 0.38. Then it went back again to 0.23, come back to 0.38 region, went back again, break through further, okay, break through further to 0.5, between 0.5 and 0.618 region, before we saw a clear candlestick pattern that actually indicate a reversal. Okay, so what happened is when this happened at each retracement level, what you will look out for, you will look out for candlestick pattern that will indicate to you that yes, this is trying to reverse back. Now, what eventually happened after that retracement happened and you see the candlestick pattern to enter the market, it is such that where it was coming from before is going to break it and go to the next Fibonacci level. In this case, this is after this point, the next level will be the 0.27 region or so. So clearly there is an indication that as soon as it breaks this, it's going to go beyond this level before it stopped. Let's see what, okay, sorry. This is the Fibonacci. Then what happens afterward is that it breaks this. Within this breaking of this, it's still not completed yet because this is a recent formation. What will happen is that this market is still in uptrend, full uptrend. Is going to go to the next Fibonacci level after this level. We can go to a daily time frame and go back a little to look for an example of this, to place this on the chart for you to see. Daily time frame. Sorry, the network is a bit slow on this. Okay, good, super. So now we are here. As I said, let me go back randomly. Let's look at this, for example. Okay, this is another example here. Let me delete the one we use in the weekly time frame. I take this out. So this is an uptrend. In this uptrend, I place the Fibonacci tool here from the lower week to the upper week here. And again, as I said, what we look out for, sorry, where is this? I pick the Fibonacci, place here. Okay, let me do it this way first. We can extend later. Okay, so I put it here. Then let me extend it. It's still the same as this. So what will happen is as this retraces back, you check here, it breaks through the 0.23, it went to 0.38, it breaks 0.38 below, it begin to consolidate here. So between the 0.2 and 0.5 region, if you check here, it forms a double bottom, okay, it forms a double bottom. You have an engulfing candle here, it came out, come back from the same position. You have the doji candle, then this is a point that is going to go beyond this. So what I was saying is that above this is going to go to the next retracement level. Okay, hold on, let me check the button here. You have the 0 4, okay, the next retracement level 1.618 is marked on this. So if I go to this, oh sorry, the settings, let me reverse it. Reverse, okay, good. So in this case, this is the point it retraces from. It retraces from here, and it turned between the 618 and 0.5. Yes, the 0.5. So it's going to go above this to touch the next retracement level. Let's move forward. Let's see. I'll push this front again. I think it's within this zone. So if we check, first of all, let's see what the next level would be. I'm zooming it in. Okay, it was actually still there in the other side. Yeah, 0.61. 0.61. 1 second. Reverse. Okay. Did it reverse? So from here. Okay. The next level after this is the minus. Okay, I didn't put the negative side. The next level actually would be this region, will be within this region, which actually the market went after this, after it retested after I retested here, it went above this to the next Fibonacci region. So similarly, in the downtrend, what you do is you look at the immediate lower high and lower low, then place the Fibonacci retracement tool here. For example, in this run from here, if I place, I'll delete this. I'll take this out, sorry. I'll delete this. Then this is the immediate, assuming the market is here, what we do is we place the Fibonacci tool again. Fibonacci tool here in the, then to the lower wick, which is this one. Then again, when it's got to this point, it will retrace back to either this immediate one, it breaks it through. The next one, we watch what happens here. It was consolidating, no, it went further to touch the 0.5 region. Then we look for a perfect indication, that's the candle entry. When that happens, what we're saying is that it's going to break through beyond the region it started before. So in that case, immediately we spot the an entry candle here. In this case here, we have an engulfing candle here. 1 2 3. This 3 is engulfing this candle. Okay, we have a doji candle this, so this is a reversal sign, and then it formed a double top here. This and this forms a double top with another engulfing candle. So from here we place our entry. We place our, in this case it's a sell. We place our short position entry. Where is it selected? It's selected. So we observe it here. We place our entry here. Our take profit will be the next. Why is this thing not on? Let me reverse this graph. Yes, settings. So let's adjust this setting. Go to settings. Yes, I have up to this point. Okay, up to 1. Then I'll say okay. What I'll now do is to place another one immediately under this. Immediately under this, that is, which is the same length. This is the Fibonacci, which from here to here is the same length. I just want to pick the natural next level. Okay, so what I'll do, this new one now, I'll place it as an extension of this. So the natural level I'm looking for is here, which is within the place I mentioned before placing the Fibonacci. So you set your take profit here, delete this, we don't need you again. So you see the market came back here, it went back, came again, and boom, it takes profit down here. So similarly, I'll do one more run of this before I move to the next topic. Delete this. If you enter the market here, you enter the market somewhere around here, and you see a turning here. As I said, what you do is trending up. You place this your tool here up to this level, then you extend it forward. Okay, when you extend it forward, this is 0 to 1. As I said, you will take the same length of this, which is this, for the extension. For the extension, I run exactly the same, right? Then I'll place this on top of. I'll place this one, carry this on top of this. So to make it an extension, what I do first is this begin to retrace. It's either it turned back at the 0.78 region. The next region is 0.618, and at the 0.618 we saw a clear engulfing candle here to this, so which indicates a turn back. Immediately you see this, you will use the next candle after the engulfing for your entry position. So, and in this case, it's going to be a buy position instead of a sell now, which is long. I enter the trade here. What I said you should do, the stop loss will be immediately after where the retracement happened. Then the take profit will not be from the starting point of this. You take it to the next level of the which is 0.23 here. In this case, this is the position. Then I don't need this again. I take it out, and then when this reverse here, it break through the first high, and then it went straight up here to take our profit before the market proceed further. So this is how to use the retracement levels to actually place your trade. Now we will take a short break. When we come back, we go to the final part of this, of how we sum up what we learn in part 1, part 2 all together, and use it to do a look ahead for the upcoming week. Stay tuned. Thank you. Welcome back to the final section of this series. So, before we do the recap and the look ahead, as I said before the break, if you have not subscribed to our channel, do subscribe now, and also hit the like button. In this final, I need to put down some text here for us to remember as we are moving into. We'll come back to we'll have a look at what is going to play out in the next few days of the year. So first of all, before we proceed, I want to put down some points. Okay. First of all, our Fibonacci fib for Fibonacci fib fib retracement tool is for zone marking only, that is key levels. So we cannot use the tool alone for market orders. Okay, this is one. This is very key. Note that our Fibonacci retracement tool is for us to use to get our key levels in the trade only. Okay, let me continue here. The second point I want us to note is that we need to pay attention. Let's pay attention to our candlesticks at the marked level. Pay attention to the candlesticks at the key levels. That's from 1 above. Okay, this is important. Then number 3, once you mark your levels, step down to the lower time frame to pick your market entry point. Okay, it is usually not immediately that the candlestick touches the key level that you place your entry, you place your trade. You need to go and see when is the market, what is happening in the lower time frame from the time frame you are actually looking at the retracement level. Step down to look at so that you can also catch the early entry of that market. Then, and the last one, second to the last, I would say, number 4, use additional confluences to determine your entry point. In this case, it could be your moving average. You could use the moving average. It could be a double top, double bottom, whatever other confluences that works for you. You have to use it at these key levels. Okay, and last but not the least, and the most important one, is your risk management. Risk management. Risk management is you don't go all in. You use all in because you are too sure of no strategy is 100%. These guidelines would give you, yes, we'll say 95% and above for you to get the right entry. Because you are this sure, you will now go all in, placing 60-70% of your investment into this single trade because you are sure of your position. It will blow you out. The margin level would blow you out immediately. So these are the points I want us to bear in mind. Okay, these 5 points are very, very key for us. I want us to mark this as we look forward to taking any trade, not just this coming week and beyond. Every time you want to make a trade using this Fibonacci, the Fibonacci retracement levels as a guide to enter to take your market, you have to consider all these points. Now, having said this, I will now have a look at the last trend of events in the market and tell what is it that what would the last week of December, what will likely play out after the holidays. There are some few holidays in between. What are the things we need to look out for in the market? Stay tuned. So let's have a look at how this we can use to analyze this market and see what will happen in the coming days. Okay, first of all, let me look at this point here, this reversal point. I mentioned before that it is not enough for you to see just a touch here and you jump into placing a trade. You first of all need to validate this by stepping down to the lower level. That's our point number 3 here. If I come back here, let me mark this out. Let's check what happened here, whether this was a valid turning point for this trade. If I pick this tool, we need to highlight the point so that it will be very clear for us. This is the point, this is the key level here where the market turned. I would mark it out, highlight in red. You can go to this daily time frame, you can go to 1 hour time frame, you can go to 2 hour, 4 hour. These are lower time frame. Let's look at what happened in 4 hours time frame for this same region. Zoom back. Okay, so this is the 4 hour time frame of the same area I circled in the daily time frame. So here you could see that there was a downtrend. From here it came down to this level, it breaks through, came down to this level, then it formed something that looks like a double bottom here before it reversed to this and break up. This is not clear enough because you might not see this as a clearer entry. Either you go to the 1 hour time frame or you go to if you are using the trading view, you can go to the 2 hour time frame first, which is the next natural one here, and see whether you have a clear entry. In this case, this is this is where I circled in daily time frame exactly, and this looks very clear for us here now that you had from this region lower low, lower high, lower low, lower high, lower low, then you have a change of character here. Okay, with a change of character here, meaning instead of forming another lower high, it rather breaks this becomes a neckline. It break through and then a reversal. So immediately you saw this breakthrough here and a retest here. This is the perfect entry position for this trade, right? Then, and as we said, where the Fibonacci round from, okay, here is a perfect entry point. If you are able to trace this in the lower time frame, either in the 1 hour time frame, and so you place your trade from here, your stop loss will be some distance below the turning point. Then you take this is where we started our run from. You take it to the next retracement level as we shown before. I will extend this when I move back to the daily time frame, which is this. Let's compare this to the first entry we did. Okay, so yeah, here, meaning you extend this up to this point. So this would have been the perfect one for us. If I delete this one and extend this forward, okay, you see this is closer and tighter for us on our risk to reward. We have a risk to reward ratio of 8.61. So if the market had gone against us because we went to lower time frame to take the trade, you will have minimal impact compared to when you take the trade from the higher time frame. So good. Now all gone. We have the last week ahead of us, which is the most interesting part of this. You had patiently waited for this, so let's analyze this together and see what will play out in the coming days. I'll clear my chart again. Remember, we are going to now strictly follow these our trading rules to actually determine what we need to look out for. Okay. Now, what happened is already we had a reversal here, right? What we can do first of all is rule one is to place the use this to mark your zone. Okay, we have to use the Fibonacci retracement level to mark our zone. There was a run of okay, first of all, which trend are we on? We are actually in an upper trend. Sorry, yes, we are in uptrend here because we have higher high, higher low, higher high, and a higher low. So the next here should likely be a higher high. In this case, what we do is we'll look at the most recent run, which is this was the most recent run. It turned here, and what we're saying is that immediately this happened, you place your order, and then you look for the next retracement level after this. Now, to make this easy for us, let's consider this as the last run, though this was from high to low, right? And if I place this tool here, I'll place it in two ways. If I'm okay, let's look at the bigger picture. Take this out. Let's move a step ahead to the weekly time frame. The weekly time frame will help us. So this is the run. From here to here is the run. Let me shift this our guide to the right. So we had Fibonacci retracement, yes, which is this. Take it from this point to this high point. Okay. From here we had a retracement back. It turned at 0.5. Let me move this for us to see it clearly. We saw this, it came down here to 0.5. Now at 0.5, can we clearly say that this market has turned back upward? So this is what we now need to look at what happened within this region in the lower time frame, which is what we have done before, right? Looking back here, what you first of all do is to place a marker within this region, this point here, because it's more like just a single candle entry. Let's place a point here and go to the lower time frame. In this case, it could be 1 hour, it could be 4 hours. I'll prefer to go to either 1 hour or 2 hour time frame to see what happened within this region, whether this is. But if we go back to what we have learned before, this candlestick, this one with long wick here, indicates that there is a selling pressure. After the buyers push this market this week up this high, there was a selling pressure that sets in that brought us back this low. Then again, there was a tussle the week that follows, which marks this. There was a tussle between buyers and sellers as well here, and the market closed almost at equilibrium. You could see the wick on this. Sorry, I want to zoom it out. Yes. So the here you see that it's more like at equilibrium. Then the last week, the just recent week that we concluded now, with fundamental news and every other thing, we had the buyers again come back into the market and push higher. But again, here the candlestick is saying that sellers, towards the end of the week, again sellers actually came in. There's a selling pressure. That's why you had a longer week here than this. Okay, so now where will the market go next? Where would the market go next? Having in mind, knowing that this is an uptrend market. One, there was a pushback from sellers here, which draw us to this point, and there is a reversal. Now, what does this reversal tells us? Is it enough that this market will continue to go up, or there's still going to be a further consolidation? Mark you, we are almost at the end of the year, so these are things you now consider, you bring in. But the good thing here, what the candlesticks are telling us week in week out here, is that towards the end of the year we actually have a lot of players in the market. This week was a full one, another full one, and then we saw this week again. So what will happen in the upcoming week? I look at the daily time frame within this region, within the circled region. There is no much to tell here. We only had we had the run of this, and we saw that this was a very strong buyer buying pressure here, okay, which led to this consolidation within this area. I will step down a little. I step down to the 4 hours time frame. So this is how you analyze, to just be sure, because you cannot just jump into the market and then risk your hard-earned money. So we look at the 4 hours. We also look at the 2 hours. Then if possible, we go down to the 1 hour to just understand the market sentiment here that warrants this, if this market is going to go up, all up to maybe retest the region of 2135 or even beyond. Okay, in the 4 hours time frame, yes, we saw the market pressure here, the buying pressure here, which is very high. I would also move again, because we still need to know that this is sufficient. This region is sufficient. Okay, if I look further here, I can tell, even before going here, I see that after the break of this, after this, it breaks this zone, there was a retest of this zone, of this region here, so which is a strong one. And again, if we look at candlestick pattern, I saw a formation here. That this region here, let me mark it, this region here, this region here, and this, because you use, as we said, you have to use multiple confluences to determine whether you can take a valid trade or not. Okay, so there was a pattern here. You have the first call, it came back, it touches the second time, it came back, and the third time now it breaks it, which brings us to another area of interest here. We are interested in what will happen here next. Is this coming to retest this region? So this forms another region of interest. Okay, this is now a new region of interest. And if I check this region, if I extend it backward, you also see that in the past, market had come here almost with the same formation. Let me place this here to see this. We are analyzing for what is likely to come next week. Okay, but when this happened here, one, it breaks up. On coming down, it breaks through. Okay, and then retested this, and then it continued downward. So, but here now it has broken up. Is it going to break through this again, similar to the structure we have here that played out here, or is going to retest this and begin to go back? So this is now the $1,000,000 question at this point. So first of all, we need to watch, be careful with this to see, because there is a selling pressure here. This is an engulfing candle. We saw that the last 8 hours of this trade actually engulf this candle, which means there is likelihood that what will happen next is to see a retest of this region, either a retest or a breakthrough. Talking about region, what we'll do, I usually don't use a straight line to determine my regions. Oh, interesting. Very, very interesting. Something just caught my attention here now. When we talked, yeah, let me move this back to this level before I complete it. They actually observe a gap here. There is a gap between this point and this point, which means that this force is likely to come back and close this gap. That is one thing to look out for. That, okay, why this is coming here, I was thinking is going to do a retouch of this and go back only, but there is an observed gap here that needs to be closed. So this is the first point of interest. How do I talk? I said I don't usually use straight line. I need to mark this region properly. So what happened is this, I use the rectangular tool. Is selected. So this is actually a region. This is the region of interest that has this. So what we are going to look out for, I'll take this out now. I talked about confluences. Watch how I plan my trade. I'm actually doing a live trade plan for next week. I would wait to see my opportunity. Then if it happens clearly, I'll take the shot. So this is what happened. This region is a region of interest for next week. Let me fill it with blue. Border also blue. Yeah. This is a region of interest for me. I need to lock it. Lock this region. So now remember, this is a region, this is another region. Within this region, it breaks through this region, it retested, it came up here. Is it going to come back to retest this before going up? We are still in uptrend. Or is it coming to close this alone, then go back? If we have within the 4 hours time frame, if we have a test of this region and we don't have the candle break, a candle closing below this region, then we would be looking forward. We'll have to go down again to lower time frame. Preferably in this case, you go to the 1 hour time frame. Okay, let me open the 1 hour time frame up. You see the gap is clearly shown here. Oh my god, a lot of interesting points here. Look at this. There is a lot of selling, a very high selling pressure here that actually forces the market to come this way. Okay, then there was a pullback of buying pressure. Again, we have the selling pressure coming in. So clearly, at the beginning of next week, starting tomorrow, we are going to see market come, first of all, try to close this and likely break through. We can't tell, but if we see, we need to look for either buy or sell entry from this point. So this comes here, it comes back, it's going to come back here. The other thing I do usually is to look at this engulfing candle. How far can I trace it back? There was a similar occurrence within this region. If you see this here, within this region, there was an engulfing. So I have another rule I trade. So there was after consolidation here, there was an engulfing sell here. Okay, then it went down. It went down this level. Then it came back again, and another engulfing has formed here. So for me, what I would be looking out for, listen to this carefully, what I'll be looking out for is that if I see a candle. First of all, I'm very sure that this is going to happen. I will do a quick trade setup for this one to make sure to take this. I don't know how far it's going to go up. But as soon as I see this close, let me make my market entry. As soon as I see this close, then what will happen is that, okay, first of all, let me expand this again to analyze further. Sorry, let me analyze this further, because I might actually be opening an early trade as against my initial thought. I want to see what happened in this region in the 15-minute. Yes, in the 15-minute time frame, I have this, any pattern, any useful pattern here. This is like an M pattern. Yes, I saw a pattern here. Let me turn it to, if you are following, it's interesting, right? I will turn it to a line. Yes, I have this. Will I call this a change of character in the 15-minute time frame? In the 15-minute time frame, what am I saying? What is this telling me? I have an M formation here. 1, 2, 3, 4. Then this is more like a small retracement, no, but a bigger retracement here. Then it moves. So here, what will happen is I'm going to take a risk here. This is a region. If it breaks here, as I said, and I had a gap, I talked about the gap. Let's look at this. I had a gap here to cover. This gap is of interest to me. So because it's going to cover this gap, I will wait for a break of this a break of this structure here. There is a consolidation. So my market entry would be within, in the 15-minute time frame. Once it breaks this zone, then I would take my market. Yes, this is the region to break in the 15-minute time frame. Let me put it as red, mark it bigger, 4. So I will wait for a close below this line to take my trade. So using this, if I'm taking my trade here, I want to make it as tight as possible. I'm going to take a short trade here. My stop loss, to be on the safer side, would actually be to place it above here. Okay, to place it above here, stop loss. We'll look at it. Then my take profit would be the next. In this case, it's going to be a very long one. Let me go back up a little. Let me go to the daily time frame. I will extend it when I get to the daily time frame. Oof, it's very small for me to see. Okay, sorry. I go back to 2 hours. I need somewhere I can see it clearly so that I can extend it. Yes. So I extend it here first. Go back like this. So go to the daily time frame. Let's look at it, what is looking like there. Where is this thing? Why is it not visible here? 2 hours. Is it in the 4 hours? Yes, it's in the 2 hours. Is it in the 4 hours? Yes, it's in the 4 hours. Okay, let me see the visibility, current and above. Yeah, then in the daily, why am I not seeing you? Okay, good. So this is the trade here in the daily time frame. So this is a risk to reward ratio of 2 to 0. Yeah, it's still, there is every likelihood that it comes to retest this zone 1. This is my first take profit. Let me put a text there. Here, first TP. I'm going to open first take profit. Excuse me. This is my first take profit here in this region. Then my second take profit, because by the time this is coming down here, as I said, I'm not ruling out the possibility of this happening. So my second take profit would be somewhere here. Let me see. First take profit, then second take profit. Take profit 2 would be here. Second TP. Okay. And by the time this is playing out, if it breaks through this, I am looking back to, yeah, my second take profit would be here. So this is how I would place my trade for next week. This is my trade setup, and this would give me a risk to reward ratio of 3.9. I'm not ruling out this coming back to this level before going that, but what is guaranteed is this first TP. Second TP, let me make it not that. Yes, I'll make it. No, it's too faint. I still want it visible. Yeah. So the second take profit is not there, but first take profit is, to me, somehow guaranteed for next week. So this is it. A recap one more time of what we. Where is it? Where is my text? The weekly time frame. So our recap here is that we use the fib retracement levels. We use the fib retracement level to mark our zones. Pay attention to the candlestick at the key levels, which I said here before we place this trade. Already I have marked the areas. 15-minute time frame is showing me what is likely going to happen next. The candle patterns here also showed the opportunity, the gap opportunity that I had to close. That's checking from the lower time frame. Additional confluences here that we have used is the additional confluence we use here is the engulfing candle. And as we saw, when we look backward, what happened within this region, similar region in the past, we saw that there was a strong engulfing sell. Sellers are able to push the market further downward, which is exactly playing out again now. Coupled with the fact that there is a gap to fill, I am very positive that the market is going to go first. It's going to go to the 2009-2010 region where I placed my first take profit. And if that happens and we have more sellers coming into the market to play, then I risk a second trade that will go to the 0.5, which is 1971-72 region before the end of the year. We are not ruling out a U-turn, a full U-turn that will take us out, but the first take profit looks somehow guaranteed. So I would like your feedback on this video. First of all, please hit the subscribe button if this gave you some money at the end of the day. Towards if it put a smile on your face towards this closing period of the year. Gone back to the comment section and comment on this. We will do more of this in the new year when we flip over to the other side of the year. Thanks for staying with us. If you had stayed this long, thanks for staying with us. Please make it count for us. Don't forget to like this video and hit the subscribe button to our channel. Most importantly, I would like you to come back after the week, the closing week of December, and comment if you take a trade. How did the trade played out? What also you could do is that you could do this. It's not mandatory that you do this on your live account. You can use your demo account to just follow this instruction and then prove to test what we have analyzed here, and come back with a screenshot of your trade for the coming year. Thanks so much for listening and watching. Please, again, if you did not watch the retracement, the Fibonacci retracement part 1, go back and watch it. It will make it easier and clearer for you what we have done in part 2 now. Thank you, and have a wonderful year-end trade. Bye-bye.